Pro Trader Strategies. My name's Eric Wilkinson. This is our options guide and cracking the code to trading options. So basically what we're going to do in this videos is really drill down on the option components that really drive the pricing. And I'm going to start out with simple concepts and build the real life examples throughout this video. So bear with me. We'll get to the option stuff here in just a little bit, but let's start out with some simple concepts that we can all relate to and learn from before we start moving on to some of these other things that we talk about with options. All right, so let me start. Hey, I remembered, folks. So we'll start sharing the screen here and get on with it. Like I said, this is the options guide. We're going to be cracking the code for options here. In this particular video, we're going to get to it, but we're going to eventually talk about the short call spread. And in this environment that we're going through right now, a short call spread is actually what I've been talking about in my daily market videos. These are videos that I do every single day on spotting the trades, and I talk about the volatility and trades that I can find on any given basis. And we talk about the markets as well. But I've been talking a lot about this. Why? Because we've had these pullbacks in the equities. And I've talked about it. On the dead cat bounce is when we want to be selling these things like the short call. We did the short call last week on NVIDIA. And if you followed that trade, who raised their hand? If you guys followed that trade, that was a pretty good one. Oh, and another thing. Hey, I played around with the sound on this. Let me know how the sound is, because I watched a couple of the older videos and it sounded like the mic was turned up really loud. So I turned that down just a notch there. Maybe you guys can notice that. All right, so before we talk about that, let's start talking about this. Because when we turn on our option screens or open up that option screen, what ends up happening? It just looks like we are walking into a fighter jet's cockpit and all kinds of things are going crazy inside of there, right? Well, that's kind of what this feels like, the streaming of data. But this is the most streamlined way to transfer information, is zeros and ones, okay? So what we're going to do is try and break down the options and those components so it's as simple as looking at it, freeze frames, O's and ones, all right? So we're going to try and make this simple, line it up so we can all see, break away all the layers, peel back that onion, and ultimately we're going to be able to understand when you open up that option page, you won't get that angst or that feeling of, oh my gosh, here we go again. What is pricing? I don't know if I should be buying or selling. As a matter of fact, I was in a trading room earlier today as a guest, and they were all talking about buying calls in Apple. All right. And we'll talk about that as we go through this video. I just thought it was kind of crazy, especially the way that I teach. All right. So who's watched housing prices lately? Anybody? Or even bought a house? If you looked back all the way to 2016 or 2008 coming to today, we've seen housing prices all over the place. Even during the pandemic, we saw housing prices dip for a brief time and then re-skyrocket to the upside. So if you've bought a home or been watching housing prices, you've seen that they've really been all over the place. And are we at a point right now where we've seen these housing prices skyrocket, right? We've talked about that. Housing prices continue to climb in price. But what happens with this whole dynamic? There's levers and pulleys that actually make housing prices drop. And one of those is when interest rates increase, folks. If you see interest rates increasing, housing prices usually will have a tendency to start rolling back over. Why is that? Well, it's because when we're looking at our budgets, right? If you look at a budget, you break it down, and usually they say 25% of your income goes into purchasing your house. That's what you should allocate at most, folks, at most. And I am not a financial investment professional, so please speak with your investment professional about this, but it should be less than 25%, generally speaking, is the street number. So if you think about 25% of your budget going to buy that house, what happens is you have, let's say, $1,000 for a mortgage on a house, right? That's your budget. Well, as interest rates increase, that means the cost overall of that home goes up, right? So you can't afford it. So when that starts happening, we start to see the housing prices pull back a little bit. I don't know if we're going to see that this time because there's a lot of inflation going on as well. And those inflationary, like the metals and the plastics that go into building that house, those prices have gone parabolic as well. All right. So the easiest thing to do, even with a house, is buy low and sell high, right? I mean, it's simple. Just go out and buy low and sell high, even on a house. The problem is, folks, is it's such a novel idea, but what does it mean? What does buying low in a house and selling high mean? We don't really know if a house is high right now, right? All I know is if I sell my house, I probably can't just go sideways and buy a house that same size, right? Or I'd probably pay more, especially if I was looking at a different neighborhood possibly. So this concept of buy low, sell high, when you're looking at a chart, seems very easy. Yeah, you can buy it down here. It's everybody, right? This is where you buy. What happens if you miss it though? You know, I mean, you never know. If you didn't get that like opening price and didn't see all this going forward yet, you wouldn't know necessarily if you bought low. I mean, you could think, all right, I'm buying low here, right? Ride it up, comes back down. You sell. Did you sell high? Well, no, not really, right? So what we're trying to do is make you understand that when we're looking at homes, if I'm looking at this pin or anything like that, the price of these things is fluctuating due to supply and demand. So whether or not we can tell if price is cheap is very difficult on an asset or anything like that where there's supply and demand issues going on, right? So while this is a novel idea, what happens a lot of times is we see the move higher and you end up, I let the cat out of the bag, folks. But what we see happen is folks might see this move higher, right? You missed maybe this trade here, and it comes up and it pulls back and you're thinking, oh my gosh, this is such a buy. And you're, oh my gosh, I am a genius, light bulb moment or something, right? Or, oh my gosh, I've got this all figured out. It's going higher. I'm brilliant. And then boom, you're like, oh, whoa, what just happened? Goes higher. All right, we're going to get that relief rally. And then boom, sell. I'm out. Because basically when you think it's going through the bottom support level, and a lot of you guys are probably better chartists than me, but I would look at it like trying to find some lines in the sand there and find those support and resistances that way as well, as I'm sure you do, and might not sell on that. But most folks, once they see something like this happen, that is panic at the disco, folks. And that's where people start puking, right? And then boom, takes off and you're thinking, oh my God, it's right back to my buy, right? And what is going on? All right. So when we're talking about price and stocks and stuff like that, we have a difficult time trying to justify price. What is Apple's value? It was up a little bit today, right? So what is its real value? Well, we always do this on forward earnings and multiples of that. And is that realistic? That's the real question that everybody asks them. This price is reflecting forward earnings and multiples of that. Is that going to happen, right? So it's hard to tell if price is expensive or cheap, especially in a market that is trending higher. Trying to find those support and resistances is definitely more difficult. It takes more of a professional, really. It's usually really easy to see neutral trending support and resistances, more so than the negatives or the positives, okay? It takes a little bit better, a keener eye, I should say, for finding support and resistances on bullish moves or bearish moves. But those market neutral ones, it seems to end up lining up really nicely with our eyes. So what I like to do when we're talking about trying to figure out pricing is we can look at volatility. because one of the major drivers of price in options pricing is volatility. Volatility will give us a bit of a clue as to what pricing is in the options, okay? Now, let me repeat that because I might have blown a couple of heads off right there. But what I'm saying is I'm not talking about VIX. What I'm talking about here is Vega, or implied volatility. Vega is just a fancy name for implied volatility, folks. So if you hear people talking about implied volatility, it's also synonymous with Vega. But volatility looks like this for a particular underlying, this chart here. And what we see with volatility a lot of times is it does trend sideways like this. So with that said, we can find a lot easier, our eye draws to it a lot easier. Didn't like that line. And that was probably my straightest line ever. Support and resistance areas. That was not a very good line. Support and resistance areas like that, right? So what we could do is then make a couple of educated guesses on something like that. So I'm telling you, volatility is the key driver of any option price, okay? Because when this increases, this number here increases or decreases 1 percentage point, if it decreases by 1 percentage point, then all of the options correlated to this stock, it could be XYZ, ABC, PDQ, whatever, this stock has seen the pricing come down in the options. I haven't even talked about price of the underlying, what it's doing. I don't care at this point. What I want to do is determine if prices in the options are cheap or expensive for this underlying through looking at implied volatility. Does that make sense to everybody? Give me a little feedback. I'm hoping I'm not losing anybody out there. Smash the like button if you had a light bulb moment there. So if it pulls back 1 percentage point, goes down 1 percentage point, all the prices are reflected by the Vega coefficient, all right? Vice versa, if it starts moving higher by 1 percentage point, all of those prices in the option montage, which is where you see all the different strikes and stuff. If you hear me talking about the option montage, it's that page that has all the different months, the different expiration dates, and all the strikes, all of that stuff, okay? So you will see all those prices just incrementally increase if volatility increased by 1 percentage points across the board. And that means not even a day went by, the stock didn't move a penny, okay? We would see the prices move. Now, a lot of folks will say, hey, you know, price is really determined by theta. Yes and no. If this is the 23rd day to expiration, well, theta is going to be the same for that underlying on any given month. April comes through and it's the 23, or actually June comes through when it's the 23 day, right? It would be reflective of that theta for that underlying. But on any given day, if volatility increases or decreases, those premiums will increase or decrease. I'm not talking about theta where the more duration you have, of course, those are more expensive, those options, I'm sorry. Those options are more expensive because you're paying to have more time, all right? So that's why it's more expensive further out the curve or further out on the calendar, right? Those are more expensive because you're paying for the opportunity to be involved longer, all right? But those further duration options are going to fluctuate more wildly due to volatility, all right? The further duration options will be more affected by Vega or implied volatility, all right? And the reason why, think about it. Why would it be more volatile further down the curve? Because it's unknown. We can kind of figure out what's going to happen in the next week or 2 weeks. You know, that's everybody can kind of figure, or at least has their assumption, but 6, 8 months from now, does anybody out there know what's going to be happening? I don't, especially the way that the world is acting right now. It's even more so unpredictable. So that's why volatility affects further duration options more. So as volatility increases, those are going to move higher or faster. I think I need to be pointing that way. But those will move faster, okay, and be affected by volatility more because it is unknown. That creates more fear. Unknown creates more fear. So with that said, what I like to do is try and find those, areas of resistance. And a lot of times, folks, I will discount, the older 6 months. I like to go 6 months forward, especially right now, because what happened, 12 months ago really isn't going to be affecting us like that now. We've gotten a little bit more accustomed to some of this volatility and the whole pandemic here. So what you really want to kind of do is draw like a 50% line, 50-50. And really, if it's in the upper band, you want to sell options. And if it's in the lower band, that's where you're looking to buy options. Okay. And it's a bit of a ballpark there. And if you are really new to options or really risk adverse, then I would say you could go 25% here. That's where you're looking to buy. You want to go to the extremes, maybe. Wait for those extremes. All right. I'm a more aggressive trader. It kind of gets above that line in the sand that's going to be my determining factor there, ultimately. And then we could look at other ones where we've gotten the higher volatility. Another thing is, folks, you could draw your lines a little bit further away. I like it to have a little bit of a piercing action happening, because that really kind of sets off the alarm that, hey, we're overdone on volatility here a little bit. It kind of gives me a little bit more of an indication. So however you guys like to set up your charts, some people like to try and hit as many tops as they can. Some people like to try and hit the fewest tops as they can. Okay. So that's going to be your decision to make that around that, and how you're comfortable really is what I want to say there. But here we could say that because it's above that 50 line, it would be an opportunity to sell, right? Something you'll have to take into account for yourself is the fact that volatility looks like it is on the rise there. And if volatility is on the rise, right, we don't want to necessarily be selling options if volatility is going to do that, or even worse, continue up to here, right? So again, wait, especially newer traders, you're just learning this stuff, wait for it to be very close to that area or piercing and start to look to roll over. Because when it starts to roll over, right, you can see a lot of times it doesn't really hang out very long before it really starts cratering. So start to see it roll over. Maybe that's your key to start getting involved, all right? A little bit less aggressive trading style there. But again, be above that line would be more of a sell zone. Here we have we're going to have a lot of sell zones right now. Why? Because volatility is through the roof. Again, you could draw your lines on this chart, and since you got a couple of tops here, I might end up wanting to draw my line across that and then a couple of lines down here if you're a little less aggressive, right? Kind of ballpark that middle. We're in a sell zone. So for ABC, whatever your directional assumption was, if you are thinking it's a bull move, right, you would not want to be buying calls. No, do not buy calls when volatility is starting to roll over there and in that sell zone. That's what I was talking about with Apple. Apple's going through the roof and folks were buying calls in that, helping volatility. So again, this would be a situation where you could be looking at this would be more of a buy zone here, right? Because we're basically looking at kind of being below that. If you wanted to do a less aggressive line, my line would probably be somewhere like right in there. my line again, and then somebody else probably would pick that line, okay? But at the end of the day, we're still going to have a very close to that sell zone, right? Sell here, and we want to buy, PDQ, right? You want to buy PDQ, especially because it looks like volatility is starting to rise there. So, a less aggressive person that might be waiting on, I wait for this, but maybe you start seeing this get a bit of a turn, and that's your key to starting to get involved here. So if I haven't beat that dead horse enough, volatility is the key component that is going to drive the price. So let's think about the example of volatility. When we see volatility in the markets, that's driving price. I mean, we're seeing volatility across the board in everything from cars to RVs right now. It used to be everybody wanted an RV during the pandemic. Now everybody wants to sell them. So the volatility in pricing there, yeah, RV prices were looking like car prices above MSRP, where they were saying it's the retail price. They were eliminating MSRP. I'm still seeing car dealerships do that. They don't list the MSRP. They list retail price because it's above the MSRP, all right? Nobody ever used to pay MSRP. Now folks are paying $5,000 over to get that retail price. And so we see that volatility happening across the board. So driving price is price fluctuation is synonymous with volatility, and it's no different in the markets. We can look at a longer duration shot of, say, for instance, Lululemon. I was looking at Lululemon for an opportunity to sell. We got this candle in here. Looks like more of a bottoming pattern. Today, though, we got a counter opposing doji. And if you guys watch my videos or anything, you guys know that I'm talking about, let me see if I can change my color. When you get a candle that looks like the bottoming one there, all right, that usually looks like a bottoming pattern. But today, the market ended up, I believe, like this. I cut out a little bit early, but like that. That usually, when you see those two line up together, it's a continuation. So if it was in a bullish move, it would be a bullish continuation. In this case, what Lulu is looking like is a bearish move. Is it finding a bottom? I don't know. There doesn't seem to be any support and resistances that I can really find. So I would expect Lulu to come down to about this level. So I haven't pulled the trigger on this. As a matter of fact, it really wasn't fitting the rules that I come up with for creating a short call spread. So I have a couple of specific rules towards the end here when we're getting into the minutia of this strategy, what we're looking for there. So when we're looking at this, we want to take our lines in the sand wherever they are. I say 3 years out. I like to discount that. I don't necessarily want to wipe it from my memory because that should be a place where if there is another massive spike, that's probably where it's going to stop again. So I might have that, charted out just as a line there, maybe a gold line or something like that, to get my mind thinking. But for right now, I would probably be looking at, trying to draw a straight line on those for determining whether premiums in the option montage were expensive or cheap. All right, so a little bit of bonus section here. We're going to talk really quickly. Sorry, I probably screamed into the microphone there as I leaned over. All right, so really quickly, what I want to do is talk about a few of the things we're going to see when we get over to the option montage. But what I'm going to do here, like I said, build from simple concepts. I'm going to give you guys some really relatable things, hopefully, to remember these Greeks, and so that it kind of just takes the mystique off of it, lifts the veil over it, so that really the understanding and the fear is gone. The understanding is there and the fear is gone. All right, so delta. Delta is, don't have to fear the Greeks. I love this thing when it doesn't work. All right, so let's talk about delta. Delta, right? Everybody's probably heard of Delta if you've traded any options whatsoever, right? Delta is one of the main ones that everybody talks about. And they always talk about it as being how it really affects your premiums, right? Or the rate of change to the premiums, because Delta is rate of change, right? So what we'll see with the at the monies, the ones that are right there where the underlying is trading. So like the underlying was trading 100, the at the monies are the 100 calls and puts. Those are the ones that are trading as close to the underlying as possible, okay? So those deltas are usually right around 50, okay? We can split hairs. Let's just call it 50, all right? It's a 50-50 probability of being in the money by 1 penny, just 1 penny at that expiration date, okay? So that's all the options. So if you saw like an 80 delta option, that's the one that's in the money. A lot of folks are always like, hey, go out and buy that 84 delta option and it's in the money. You know, you're not paying a lot of theta, but you get this big bang for your buck because the delta's so big. Yeah, but the problem is when the market moves the opposite direction, you got a lot to lose. So when I'm talking about mine, I talk about different strike locations. But it just means a 50-50 chance of being in the money. So those deep in the money options, yeah, has a good probability of being in the money by 1 penny. If you bought that 80 or 90 delta option and it finished 1 penny in the money, you were right. You won the probabilities, but it is going to be extremely painful because you lost a lot of money. All right. So I prefer a different trade there, and I've got a little sideways. Sorry, guys, on my rant. But I wanted to come to the fact that in the monies are more likely to be in the money at expiration than the out of the monies, right? Out of the monies, you would expect to be out of the money. So 1 penny in the money. But the other thing that happens is the rate of change. So all of the Greeks assume that there is an advancement, okay? So delta is an advancement higher of $1, okay? So if the underlying moves higher by $1, those at the money strikes will increase by 50 cents, okay? Underlying moves higher by $1, the premiums increase by 50 cents. That's what it's telling you. It's all on a multiple of 1. Now, the one thing that I would like you guys to take away from this, because I'm sure you guys most likely already know about this far of Greeks, but a floor trader hack, all right? And this comes about a lot in some of my rules that I'm trading. And I really dig into this in the videos that this is going to be a major milestone for. But delta tells us it has 2 times the delta equals your probability of touch. Okay, so think about that underlying trading $100 and I buy the 100 delta strike. Oh, I got a pretty good probability of going 1 penny in the money, don't I? Or at least being touched. So it's probably close to 100%, right? The ones that are in the money, yeah, you got like an 80 delta. Well, that's about 160%. You can't go over 100, but you know, it's got pretty good probability. It's really is for the ones that are out of the money. So like a 16 delta that's way down here, right? You got a 16 delta. It's got a 16% chance of being in the money by 1 cent at expiration, meaning, you know, 50 days from now, on that 50th day, it has a 16% chance of being 1 penny in the money. But during the life of this option, 2 times the delta, or 16 in this case, equals 32. So 32% probability of touch, meaning not in the money or any of that. It just means it comes up and trades that strike for 1 contract even. It's just a print, okay? So 2 times the probabilities, those are when you can start looking at it and keeping your powder dry if you're getting tested on it, or, you know, if it's a winner, then that's when you would want to cover it. Okay. But don't try and go for the full gusto and think, oh my God, this thing, I'm brilliant. It's in the money. It's going to stay in the money. Well, the probabilities say it's not. And the math says you've beaten the probabilities. So that means, for me, pull the ripcord. All right. So that's delta, rate of change. But more importantly, 2 times the delta is the probability of touch, or on the floor, probability of getting kissed is what we used to say. So delta is on the dollar move. Then we have gamma, and not a lot of folks talk about gamma other than gamma trading. And they like gamma trading because it gets really jacked up closer to expiration. But only thing I need you guys to think about is gamma is usually a pretty small number. Closer to expiration you get, it ramps up. I'm not gonna lie, especially close to the at the monies. But delta was the first dollar, right? We talked about delta being the first dollar. Gamma is dollar number 2. So, for instance, when we were talking about our $100 stock, we had the 100 strike. Let's say it was $1. Okay, it's actually probably like $5. Let's say it's $5 for something like that. Now, on the first dollar move, my premiums went from $5 to $5.50. Hot move higher. On the calls, went $5 to $5.50. On the second dollar, gamma goes with delta. So then it would be 55 cents going in on that second dollar. So $5 went to $5.50 on the first dollars, or the first dollar move. The second dollar move, it goes to $6.05. All right. So it gets that extra nickel added in there. And it depends on what gamma says. You know, gamma is going to be its own little number there. You have to look what that number is telling you. And then we've got the thief. The thief in the night that comes and steals your premium. His name's Theta. All right. Now, Theta likes to steal your money. But way out in time, he doesn't even know you're alive. Well, actually, he does. He comes and taxes you just a little bit. But the closer and closer you get to expiration, he starts taking fistfuls. All right. He wants every cent out of your pocket before that expiration, because as soon as that bell rings on expiration date, he's done. All right. So Theta is the thief in the night. And this is on one day. One day goes by, and that Theta number, which is always negative, Theta is always negative. Why? Because you can't go back in time, folks. All right. Theta is negative because it's an advancement in time. So even in the calls, the puts, they're both negative because they are getting their pockets picked by the thief. And then we've got Vega. All right. And like I said, all it is a fancy name for implied volatility. All right. Implied volatility. They threw it over here, and somebody real cheeky was like, well, we can't have implied volatility over there if we have a bunch of Greeks. So let's name it Vega. Well, guess what? Vega is not even a Greek. So implied volatility, Vega, it is on that 1 percentage point move. And it is affected by the further duration options more so than the near ones. We've already beat that dead horse, right? We've got that figured out. Further duration options, oh, there's more volatility because we don't know what's going on, all right? Theta doesn't hurt us way back there, but nearer duration options, he really gets aggressive. He starts taking fistfuls, right? So sometimes you want that guy in your back pocket, right? When would you want Theta to be in your back pocket? When would you want him taking fistfuls? If you sold, right? If you sold options, that's when you want to take advantage of Theta. Remember I said he wasn't very aggressive way out in time, but the closer and closer you get to expiration, he gets more aggressive. So every night it's not linear. It starts increasing. So what we see with volatility is that it kind of further out in time starts out like a slow fall, and then it's whoosh, it really starts dropping off. And basically we can look at it like this is 7 days to expiration. 2x. All right. And then 35 days is the real sweet spot for selling. So this is your sell zone. Now, I do say like getting involved around 45 days to expiration is about my extreme going out in time. All right. Guys, when we flip over to the option montage, you'll notice we're at 50 days to expiration and like 23 days to expiration in the option montage, I think. So 50 days, still a little bit long in the tooth to get out there, all right, and start selling. It's a little early. But the buy zone, I like to say, is outside of 70 days to expiration. All right, that's where I look to be buying. Because if I buy outside of there, it will allow me to get inside of that, but not too close to that real ramp or that slope that really starts. This is, like I said, theta. All right. Really starts picking up. And I can show you that when we show it off in this page here. And this is what I've been talking about with the option montage. So we've got our calls. Let me go to change my color here. All right. So we've got the calls. Maybe white isn't the best option. We've got your calls and we've got your puts. Now we're going to talk specifically, and I've kind of been sticking to the calls because we're talking about a call spread today. But what we can see is here's kind of around that 7 days to expiration I was talking about. And here is theta. And look how little theta takes advantage here. You can see the different months that we've been talking about, 70 days, very close to it anyway, right? So when I was talking about if you're in the buy zone, you want to get in this buy zone because look what happens. You go 28 days to that area, and look, we did not see theta increase really very much at all throughout this entire time. Very consistent, but not a whole lot. If I had gotten involved from here to here, look what happens. The theta starts almost doubling, really. As a matter of fact, we go a couple more days, and that's probably going to be doubled. And then you only go in like, less than 15 days, and it almost doubles again. So you can see how this starts really increasing as you go out. Now, we can also look at deltas being at the monies, right around that 50. Delta is pretty consistent throughout the option montage. Now, further duration options, a 16 delta is going to be a lot further away than the ones that are 16 delta, inside of 20 some days. That's going to start coming in because you have less time, right? If you have less time, the probability of a big move becomes theoretically less. And here we go with gamma. We talked about this as dollar number one, dollar number two, and we can see on dollar number two, gamma goes with delta, all right? Gamma just goes with delta on dollar number two. So when you're kind of looking at your option pricing, you can kind of get a pretty good gauge as to how much, if this underlying moves by $2, am I going to be up or down money, okay? And then Vega, as you can see, Vega, its coefficient, much less here than further out in time, all right? So real sweet spot for selling is outside of 45 days to expiration. I screwed that all up. 45 days to expiration and in, we would look to, why am I stuck on that? Sell, we sell inside of 45 days to expiration and outside of 70 days, that's where our buy zone is to limit the theta decay. And if we're buying, right, we want volatility to go higher. So if it's going to go higher, it's going to affect those near duration options more. Now, why do I sell inside of 35 days to expiration with volatility kind of not being a coefficient that really jacks it up? Well, it's already gotten jacked up. And when volatility comes out, it comes out pretty precipitously. So all of those things coming out, and I've got theta in my back pocket, is what I want to do to try and turn the tables of probabilities in my favor, all right? That's all I'm trying to do is just get that little nudge of the tables of probability in my favor, and I'm good with that. So by selling high volatility based on my directional assumption, like if I'm bullish Apple, you know, as a matter of fact, here, why don't I keep talking about Apple? Let's just pull up a chart of it. Hopefully I can pull up a chart. There we go. Apple just blasting off to the upside. Now, folks were buying calls in this move to the upside. So that's going to hurt you, right? Or that's going to help you if volatility increases. But what's happening after that move? We saw volatility moving up. We found this support. And today, folks were buying on that move higher, which is what people do a lot of times. They'll jump on buying those calls when the market's moving higher. That's usually when markets are moving higher, there's less volatility. People are not worried about upside risk most often in the equity markets, all right? They're worried about downside risk. So the fear happens when volatility or when the underlying starts falling out of bed. People are buying puts with no regard, and that's what's driving price higher and volatility higher, okay? And on the flip side, in a market like this market moved up $7. Now, you can see that dollar move versus probably only a couple of percentage points coming out here wouldn't have really hurt you too much. But that 1 percentage point drop in Apple's volatility, those premiums actually came down despite the fact that you were holding calls, okay? Yeah, you were probably making incremental gains as the underlying went up through Delta. But the other thing is you have to really be worried about Vega when you see like these massive spike downs, right? If you had bought, say, anything on this day, even if you bought puts at that high, that volatility crush coming out could have easily offset the gains you made on the trade. As a matter of fact, we could probably pull this together right now with this type. Let me try and erase everything, just because I'm talking about it. Erase all on the slide. Let's go to a pin. See, we didn't talk about this last week, so you guys got a bonus if you stuck with this one. And we were talking about, what was I just talking about? What was I coming over here for, folks? Somebody throw it over in the comment box. What was I going? Offsetting Vega. All right, so Vega can easily be offset. So let's look at this, for instance, on something out here outside of 70. Let's go to this one. All right, so 57. Now, if I'm going to look at Freeport-McMoran's chart, let's just pull up today's chart of FCX. And we can see volatility is starting to come out here, right? Those counter-opposing dojis, I think this is going to be a continuation. I think the next stop is somewhere down around here. So let's just say with something like this, we got volatility coming out today from 61 to 57, right? 61 to 57. This thing ended up slightly higher on the day, right? But let's just take a look at it. Had this market gone down. So, let's look at how far down did it move, Wolf. All right. So we got, what did we say this was? 61 to 57. So we got 4 percentage points. And then we went from, say, for instance, 41 to what was the bottom? 50. 41. Let's call it 41 and a half. Can we say it's $1? So I don't have to split hairs here. Let's just say it went from 42.50 all the way down to, all right, we'll go $42 move down from the top. Let's just say I did something at the top. All right. So $2 move. Is that what I came up with? $2 move, 4 percentage point. So a $2 move, this premium, let's just look over here at the calls. I don't have my pen. I'm trying to get my pen to show up. All right. So go to these 70 some days out. All right. Straight across, looking at these. All right. $2 move and it went down. So we had a negative $2 move in the underlying. So this premium, let's say, just went down by the delta, which would have been, where's my delta? 50. All right. So 53 cents. And we got $2 move. So the first dollar was 53 cents. The second dollar, we got gamma going with delta. So that's 57 cents, right? So now we've got $1.10 total. $1.10 went into these calls. So, you know, right in between there, we're 385. So now we're 495 middle market, right? On that $2 move. I said $2 move higher. $2. I added $2 move. Sorry. I'm getting all screwed. I worked on 6 hours of sleep today. So sorry, guys. I'm sorry. So $2, let's just say it went $2 from higher. We could see this go up to $4.95. I'll do it the other way as well. All right. But we had a 4% move here, right? That 4% came out of those premiums. So 4 times 8 is what? 30, no, 32, right? Still 32 cents. So 32 cents would have come out of this. So now we would be looking at 463 or something. I didn't do a very good job of doing that. All right. So that was, you know, like a good lawyer, you should only ask questions that, or ask or answer questions you know the answer to. So let's just throw it this way. Let's say volatility went down by, let's say 10 percentage points, which is a pretty easy move over, you know, a day even. So it goes down 10 percentage points. So we're trading at around 47.07%. Okay. So what would happen here is now these premiums would decrease by that 80 cents out of these. So we would be looking at $3 bid at $3.10 offer, right? Because of the decrease in volatility. Now we could go and look at it where, let's say now the underlying moved higher by $1. So now we move higher by $1. So now we're trading at 42.69 here. This was the percentage over here, right? 42.69. So now my premiums increased by that 53 cents. So now my premiums are back to $3.53 at $3.63, right? So again, almost offsetting that. So again, very important in situations like this, where when you're looking at trading, you need to take into account where volatility is now and where it's expected to go. So you guys know when you come down to a support resistance, you're expected to reverse. So that's the idea. If you come down to those support levels, that's where you start to look to buy for Vega. And when it hits the resistance area, you need to be thinking sells. So those folks that were talking today about doing that Apple trade, it was very sketchy because Apple did make a nice little move higher today. Am I going to get? Oh, come on, you'll get it. All right. With this move higher, if you're buying calls, especially heading into tomorrow, if we got one of these down spikes here, that's going to crush those folks, because we could see, you know, here's a spike from 52 down to 35, right? So 17 percentage points moves in a day. Now on those big moves, yeah, can you see it again? Sure, that's on the earnings, but we've got the earnings right there on Apple. And tomorrow we will probably see if that person's holding on to this trade, he's going to see volatility really come out. I was going to try and get my pen out, but anyway. All right. So here's what we're looking at. Now, I like to pick the 36 delta to start. You can see we don't have a 36 delta there, right? So what I do is I'm probably going to have to be slightly more aggressive. The idea here is to stay in the 30s on your sells, right? That means I only have about a 35% probability of being in the money, right? Got a 70% probability of it touching me. So I know my risk, right? I can look at it and be like, I got a really good chance that it's going to go up there and trade that short strike. But not a very good probability of being in the money. So it can allow you to keep your powder dry and stay in these trades a little bit longer, despite the fact that you're getting needled or tested a little bit on this trade. So I like to pick that 36 delta or right around it. Sometimes, like I said, I have to get a little bit more aggressive on the delta. But the idea here is I want to sell that option, and then I want to define the risk. Now, my theory is when you're dealing with anything below like $50, you're only going to be about $2 or $3 wide. You get out to the $100 ones, anything below $100, you're kind of looking at $5 wide. Over $100, if you're at like the $200 mark, you're kind of looking at a percentage. So you're looking at 20% wide, $20 wide. $300 stock, it's like $30 wide. That would be the best case scenario. And then on top of it, you want to basically try and get a credit somewhere between 25 and 30% the width. So here I've got 55 cents, right? How wide is it? $2. So you basically take the 55 into that, and it's somewhere around 26%. All right. Now, remember I was showing you that chart of Lulu. That's the one I really want to short. Well, I couldn't get my risk reward right using those 30 plus deltas. All right. I had to get into the 40s to try and get my risk reward to be somewhat reasonable. And the reason why, you got very low probabilities of being in the money here. So the idea is, you're looking at your risk versus your reward. I've got a 35% chance of being in the money. I want to get somewhere around 30% credit. All right. Risking two to make one. And the reason why you're risking more and able to get less, because your probabilities are so friggin' good, right? If I told you, your probabilities are, 1 in 4 that you were going to be wrong, and what would you do? You'd think that your probabilities are pretty good, 1 out of 4. You'd probably lay money on it. Like, yeah, I'll put $1 on my one. You're not going to hit me. Okay, so that's the same idea here. Is your probabilities, you're beating the probabilities there because it's less than 50-50, right? And so we try to define it with the one that allows us to keep a credit. And then this is our basic analysis, all right? This tells us our risk reward. Here you can see I'm risking 1 because it's 25%. I'm saying everything backwards. It's like it's opposite day. This is what you get, and this is what you risk. All right. And basically it's 3-1. Now, if it was 30%, that would have been a lot better. Then I'd be risking 2 to make 1. My probabilities still trying to shoot for that 35, 36 delta. Okay. This one wasn't able to work out. A lot of times when you get into the bigger dollar underlyings, it works out a little bit less better. When you're dealing with stocks that are below 50, sometimes it makes it a little bit more difficult to get to that 33%. And I think volatility could have been a little bit higher for this trade, but I like trying to take advantage of this one to the downside just with the setups and everything else that's going on. So that's why I chose this as my example. So hopefully you guys have learned a little bit here today. We started out with simple concepts talking about, housing and pricing and volatility and how that affects pricing. Well, volatility is the key to cracking the code to trading options, folks, because most folks just go out there and think I got to buy a call in a bullish move and I got to buy a put in a negative move. That's not the case. There's many times, like 2008, when we saw the flash crashes, even in, when was that, in like 2010 or something? Flash crash, all of that volatility exploding. When the market was selling off, volatility was exploding so much the calls were gaining in value due to volatility increase, right? So I knew people that were almost able to scratch their long calls on those sell-offs because that volatility blew up. Now, you can't do that by going out and buying and selling an underlying. It just doesn't work that way. There's almost nothing out there where you can be directionally wrong and make money. Options is the only place that you can do that. As a matter of fact, with this short call spread, I can be directionally wrong, right? This underlying can move higher by $2 and I'm still okay. All right. It will be testing me. I might even have my 44 short calls slightly in the money by 10 cents, but I collected 55 cents. So my break even is at 44.50. All right. So you add your credit in and it gets you up above that short strike by 50 cents. So you still even have a little bit more wiggle room than that. Not really able to adjust this strategy. Only thing that you would be able to do with this to try and play with it is really if you're directionally right and the market slams down, you roll it down. Okay. That would be the only real adjustment. If it's going through you, through your short strike, I would leave it. I wouldn't try and take it off at that point because you're already basically at a full loss and it's defined risk. So you knew your risk getting into it. You can kind of stay a little calm and rest on your knowledge that you know your probabilities are, we're only 35% being in the money. Now they're in the money. You're getting that 2 times the probability of the money punch in the gut. But because it's defined risk, I would hold on to it. Likelihood is it will probably roll over, especially if it's moved up that fast, that quickly. Because remember, when we're selling this strategy, we're selling inside of 35 days to expiration. So there's not a whole lot of time, and theta is working in our favor. So we try and get all of those things working in our favor before we start getting started. So I'll stick around a little bit here for you guys. If you guys have any questions, please throw it in there. If you want me to talk about a couple of different stocks that I may have not touched on, throw it over there in the comment box. I'll touch on that for you folks because you guys have been so kind sticking around throughout this entire video. Otherwise, I'll come back to it. If you guys have any questions popping up there, please smash that like button before you go, folks. It helps out. It shares this content with somebody else that crawler thinks looks like you. It's like, hey, this dude likes it. Maybe this person will like it because they have a similar taste. All right. So please check that out as well. Hit the subscribe with the little bell if you want to catch me when I'm popping in here unannounced, talking about the markets and stuff like that. It'll give you a notification during the week. I don't really give a whole lot of notifications. Kind of like when I see something, maybe the number popped out, I want to talk about it, I'll jump in here. All right. It is my imagination, or have BA spreads widened in the last few weeks? Yes. Sprite, absolutely, they've widened, and spreads will do that when we see these massive spikes, especially in something like Apple. But, you know, the VIX, I told you guys, don't watch the VIX to determine your options. I still believe in that. But you can watch the VIX and get a good broader gauge of what the overall market is feeling. Like we can look at the VIX and see, wow, the VIX is really high. Volatility across the board is really high. So therefore, there's opportunities in the markets to take advantage of that high volatility. But, you know, on the flip side of that, you could probably even see underlyings. Do I have the right one up? Let me throw this. Give me a second. So this one up. But you could also see on the flip side of it is the ones that are at or near zero, right? So in this case, Merck, would you be buying or selling? Folks, for Merck, excuse me. Right. You would be a buyer here. Yeah, it does kind of seem like volatility wants to come out, but you are below that 50% mark and really close to those support levels that I'd probably draw in somewhere around there. So I would be thinking it's a buy. Yeah, despite the fact that, you know, they think they probably just had earnings, and that's why we got that spike. As a matter of fact, I do remember seeing their earnings come out. So what did we get? A 5 percentage point drop there. Did it counteract the move higher by $5? Probably not in this case, but it could have. It could have definitely, you know, made somebody wonder, like they're looking at it like I did a 50 delta or whatever it is. This thing moved up $4. I should have made $2.20 or something. And I didn't make anything. Why didn't I make anything? Well, because they didn't look at volatility crush. All right. So you got to make sure you're paying attention to that. And the reason why those spreads have widened is volatility. Now, the reason why volatility creates wider spreads is because those folks that are in there making the markets, the market makers, guys like I was on the floor, when we see volatility spiking, it's because I know that if I'm bidding here, all traders do this. They don't just buy it to buy it. They're buying it and selling something. It's a quick hedge. They're trying to lay off a spread somewhere or hedge something. It's constant. You don't see very many people doing a lot of things just completely naked on a spec position in the like futures and stuff like that. But when volatility starts spiking, my bids go from 5 to 4. Why? Because if I buy 4s, I've got to run over there and sell something against it. And with volatility spiking like this, I'm a little bit worried about my hedge over there at my price. I'm bidding 4 because it's 6 bid over there. And I'm just doing this. I'm 4 bid. You hit me on the 4s. I try to hit the 6, right? So if it's really volatile, you know, I'm going to probably be 4 bid, 6, maybe 3 bid. You come in at 4, then I might buy your 4s and hit the 6s, okay? So a lot of times you'll see that happening because of the risk involved in the hedge. Does that make sense, Ron? Did I answer your question there? All right. So that's why we're going to, anytime you see volatility really jacking up quickly, the spreads widen because the volatility over on my hedge side is making me pull back a little bit. All right. All right, good. Well, guys, I've got, like I said, this offer for you. This is instant access to over 15 hours of content. Folks, if you guys want to get involved, I talk about the market profile. I know a lot of you folks out there are probably better chartists than me and you're learning about options. That's great. Watch these videos. Give me some comments. Tell me if I'm even charting correctly. But market profile is one of those key things. I went to college for psychology, and market profile, I feel strongly, is the psychology of the market, if you will. And I talk about that. Also, when, where, and why you would want to be buying options, trading options, and how to trade those. I go into detail in these videos, sometimes differently. Like I know some folks out there probably have watched a few of these videos, you know, even in line from the beginning of this course to now. And there's several times, sorry about that, several times that I've had where I just get off on a little rant or a tangent and talk about little things slightly different in some of these. So, you know, if you've watched this one on the short call spread and you're going back there with this course, watch the other one with the short call spread. Have different examples in those. And I probably talk about it in a different way. So I try to do every course a little bit differently so that you folks can relate to it. So some people will learn from the other ones a little bit better the way I talk, and these maybe will strike a chord with you as well. So I do appreciate you guys all. Thank you guys all for joining us. Like I said, this is the page that will bring up, if I remember to give you guys there's the link. I'll send the link through the chat window there for you folks if you want to take advantage of that. This is all the stuff, and literally what happens is you watch this video and there's a little check mark box. Oh, I guess because my pen is white, it's not going to show up. I'm like drawing all over the place. Here you go. So what are options? Basically, here's how to protect your portfolio with options. Interest rates, folks, seriously, rising interest rates. What happens when interest rates go? If interest rates are going higher, what does that mean? Well, it's a little teeter-totter, and that means that price is dropping in the bonds as much as interest rates are going up. And they're talking about 50 basis points at a crack. What's that going to do to a bond portfolio? Well, I show you what it will do to a bond portfolio, and then I go on to talk about how you can hedge that portfolio. Now, I know you can't hedge a GMO an Illinois bond against options. But if you have a bond portfolio, we can use other ETFs and things that will mimic that for you and try and hedge that so that you're not getting crushed on that price drop. Because your portfolio is reflected of price, not percent, right? The reason why price goes down when percents go up is because everybody's chasing yield. They want that higher coupon payment. So your crummy little 2% bond really isn't so exciting. All right. So try and hedge that, because you can't chase yield by selling those low percentage point trades and trying to chase that higher one. You will get scalped like you've never seen. You might not even know it because it's so hard to figure out that math, but in these videos, I show how that happens. So please check that out. All right. That's all I got. Smash the like for me, and don't forget to subscribe. Can't take that? Take it easy. Bye for now.